Money Radio for a really great future. We're talking real money.
It's one of the great American pastimes. No, it's not baseball, although finally the World Series ended a few weeks ago. It almost goes till Christmas now. We're gonna have a Christmas World Series soon. But it is almost as American as apple pie and hot dogs and all those things, and baseball. The American dream of home ownership and the buying and the selling of real estate, homes, primarily your home. That is what the supposedly the big money maker is. And folks who tout real estate tell you regularly that the way to build wealth is to buy a house. But has that been the real story? Hi, everybody. I'm Don McDonald. Welcome to Talking Real Money, the podcast. We're so glad you're there. And with me is, I love the Broncos colors. Thank you for celebrating my
trying
team.
to help you, support you if I can a bit here, since
truly
it's already over for my team. So why not, I guess, right?
I truly appreciate that. I do. The gesture is so kind. But here is a man standing in front of me who has, in the past few months, both purchased and finally sold.
You can listen to me cry.
A home. He's not crying anymore. He stopped whining because he actually sold the house.
Yeah, and I've had a lot of people ask. This is an interesting topic. I've owned homes for 40 years, so obviously I like owning homes, but I don't believe they're going to make you rich. So when I read headlines like this, buying a home is a way to increase your net worth over time. Well, that's pretty innocuous, right? Sure, that's true because it does increase your net worth.
Well, over time. Thank you.
Yeah,
over time. There have been times when owning a house has decreased your net worth in
we're
some
going to talk
parts
about
of the country.
What it's meant here in one of the great real estate markets, frankly, in the country, the Northwest.
Seattle area?
Oh, yeah, my goodness. And one of the points the article makes is that U.S. homeowners with mortgages have a net homeowner equity of more than $17.5 trillion this year. So they quote an advisor who says, as I said, this is a good way to build wealth. Home equities increased this year. And then they get into some of the specifics, which I struggle. They're so obvious. I mean, the loan, they're talking about home ownership, is usually quite large, and you have no equity in the home at that point. Well, okay, that could depend. You may put 20% down, then you have some equity, right? But it's not something that you should really be considering or worried about at that point. I mean, we've discussed this many times. Your home should reflect what you want your life to look like, right? It's a lifestyle issue, not a financial one generally. They discuss how their equity and net worth increase within 5 to 10 years. Now, that's totally random. You could have bought in 2007 and you would have waited a long time, as I did, which I'll talk about in a couple minutes.
You did actually wait a long time
to see any growth. I mean, it was a very lengthy downturn, as you are well aware. And is it better to rent or own? Well, we've done that topic too. It's really right now, frankly, with interest rates, it's probably better to rent.
We've been looking at those numbers for a long time, and even before real estate prices went crazy, it was pretty close to a wash. And over the past few years, because demand has increased and supply hasn't, real estate prices across much of the country in popular areas. The Pacific Northwest, California, Florida, Arizona, the prices have gone crazy.
Yeah, they have. Well, we'll talk about it here.
I mean, look at what you paid for your new house.
I know. It literally, I'm ashamed to admit it because I think people think, God, you must be really rich to do that. That's what homes go for here. People have a tendency, I think, in a general sense, to look at their home in terms of, here's what I paid for it. Here's what I sold it for. Look, I made $1 million. They forget about all the costs involved, both, by the way, in buying and in selling a home. They forget about the cost while they own it. Now, in my case, there was some deferred maintenance, which ended up costing me tens of thousands of dollars to fix before they even let me put the home on the market. Frankly, our real estate agent said, "This is all you got. That's got to be done. The floor's got to be done. The carpet's got to be done. The everything. I mean, the place looked like the queen could move in there or pardon me, the king, I guess, in today's world, and be very happy with the situation. But people, we all have a tendency to forget those things. Now I'm adding them all up because it's going to make a difference in my tax situation here eventually. But okay, so I went ahead because, as you said, Don, I'm at this place. I bought a home. I took on a new, very large mortgage at a very high interest rate too, which didn't make me very happy because I was at 2.4. Yeah, 2.4.
You were at a great rate before.
And I owed everybody almost nothing. And then all of a sudden felt like everybody everything, which emotionally has not been fun. And that apparently, as I say, it's under contract, that apparently is coming to an end. Never know anything till the final deal is signed. But of course, they've given us their earnest money and that kind of thing. Even that was a little sweaty. But anyway, in my case, the price of the home rose dramatically in terms of the dollars. You know, I mentioned I bought literally at the market peak in August 2007. Market went straight down. Guy next door to me got foreclosed on about 2.5 years later. And when they sold his, it was about a third lower than what I paid for mine. I was like, it had gone down that much.
Yeah. And you, here's the thing. I just want to bring it in some figures, some numbers before we get into your specifics. You can find numbers to support almost any argument. But when you go back, there's actually Case-Shiller has a U.S. housing index that goes back 100 years. Using the Case-Shiller numbers, the annualized real return on houses over 100 years, homes.
This is real or
average annual return?
Not before inflation.
This is no real return after inflation.
After inflation. Okay, because my return is before inflation.
1/10 of 1%.
This is the part people forget. So it's about 3% a year because inflation's about 3% a year.
Right. So it's about what what inflation gives you.
Thank you. This is
after you take out all the costs. But the problem is people like S&P, you'll see these shorter term numbers and they'll say 10% per year. But they don't calculate in the costs.
Yeah.
All the things you had to do.
I know.
And this is where it gets really interesting. So what did you calculate you spent?
Yeah, and I'll mention that number in just a moment here. But you just mentioned a key word here, costs.
Yeah.
So because when you go to sell it, even though the real estate contracts have changed, what I learned was if you don't pay the buyer's broker a pretty substantial amount, I think I ended up paying 2.5%. They won't bring people to your house. No offense.
They ignore you.
They do.
And
I had a couple people ask me, like,
you.
why aren't you paying us anything? God, no offense. I mean, it's not as much. Anyway, I don't want to get into it because I'm going to get in trouble. But
because you have a family member who's in real estate.
A lot of money. But there's all those other costs. And then there's the costs of, as I said, the kind of the deferred maintenance, et cetera. What did I end up making? This does not include the leverage, by the way.
Right.
I just took the dollar, which leverage would have made it look better. But my 17-year rate of return, this does not include inflation.
This is anecdotal, folks.
Anecdotal.
This is not,
3.19% a year. 3.19%
before inflation?
That's before inflation.
So wait a minute. After inflation, your return was almost exactly the same as the Shiller Index.
And this is one of the great markets in the country for the last 20 years, right? If you look at Seattle, go back to the Midwest and look at something there. So out of curiosity,
Topeka, Kansas didn't do nearly that well.
I just ran a portfolio, 80% global stock, 20% bond. That made 5.8% a year. So
over that exact same period.
So I mean, and you were liquid all the time and all this. So this is when I read the headlines, I worry because a way to increase your net worth, yes, but the opportunity cost. Just imagine instead you'd taken the rent money because you got to pay to live somewhere, right? Mm-hmm. And instead you'd taken that money and invested it in stocks and bonds. You'd end up with more money.
It's one of those, and this is where we get into the whole thought of lies, damn lies, and statistics. You can manipulate numbers to make almost any case, but the reality is that it just makes sense that stocks have made over time more money than real estate because. And this argument that they're not making any more real estate,
I love that
You
one.
know,
No more land. Well, go to Hawaii. They are, by the way.
But and all you have to do, I mean, Florida's one of the most populous states in the union. We got plenty of land.
What?
We're
Isn't
not
theirs
short
falling
land.
into sinkholes or something?
Well,
I don't
still
know.
we have land.
That's a good
But
point.
that argument is spurious. They aren't making any more land. The reality is you have to think about it for a minute. It's like gold. It's not like crypto, but
no,
okay.
please. No,
It's like gold.
Yeah.
Gold does not become more valuable in a vacuum without anybody bidding or selling gold bullion. However, businesses, they can truly make themselves more money, even if there was no market, even if nobody was trading stocks and bonds.
Thank you.
The underlying businesses that are represented by those stocks, those businesses can become more valuable over time because they make more money. Making more money increases the value. That's why stocks tend to go up. It's not a zero-sum game. It is a plus game.
Yeah, and my only big takeaways are from this are real estate, as we've said, should be lifestyle. Real estate, if you want to build, I guess in some ways, although I think it's far less than it used to be, building community in some ways and stability, right? You have a group of people that live there. And by the way, in our new location, I think it's almost a dozen people have actually come by and said, hi, welcome to the neighborhood. That didn't happen at the last one, which is fine. But
well, it's all the survivalists around you in the old place.
Well, and we're further out
bunkers.
Now. You're way out there. So, I mean, for those reasons, yes, real estate, to get rich, that's what I worry when people think it's going to really increase my net worth. Yes and no would be my answer to that. It will, but not as much as you might think.
Generally speaking, real estate as an investment is an inflation hedge or a job. It's going to, and we've just shown you the numbers both from Kay Schiller and from Tom Cock. It was just a hedge against inflation.
Yeah, shocking.
It just kept your money even with inflation after all the costs.
And I had one bad market and one really good one since that bad market really that ended in about 2012, right? I mean, things turned around, went right back up, but not enough. Anyway.
So the reality is, again, we come back to the same old dull, boring concept. You diversify your life. Now, I own a house. Do I think it's a great investment? No. Do you know why I own a house? Because if I rented a house, somebody could kick me out of the house. I don't want to move.
Stability, right. Yeah.
I don't like moving.
Bingo.
So if I own the house, I get to stay as long as I make the mortgage payment, which at 2.5% or 2.6% is like nothing.
Yeah, pretty good deal. So, and by the way, after I get the proceeds, I'm assuming this deal's going through, I'll be I'm tired of whining. I'll be able to pay a lot of this stuff off. So I'll own a little bit of money, not much. So I'll be in a better place.
You're saying you're going to stop whining?
I'll quit. Well, I'll find something else to whine about.
Okay. I was going to say, are you
always
sure
something available.
You're going to make that commitment in front of actual people?
No, I do not want to make a commitment.
You know, because these people later on,
when I talk to them,
if you made it in front of me, you could say, I never said that.
The number of people that pick on me now about the laundry room is like, can we see the laundry room?
Can we see the laundry room?
No, we're not going to see the laundry room.
If you would get your darn booth ordered.
Well, that's part of now
you'll have
getting out of Hawk. I can do things like this. So, okay, let's go to some of your questions. Alice from St. Louis, Missouri, which does remind me, I'm reading Astoria now. Have you read Astoria? God, it's a great book.
I've never heard of it.
About John Jacob Astor's fur trade.
John Jacob Jingle. Oh, no, that's
a different one. What a great book that is. And of course, no one knew anything really about the world, the North America west of St. Louis. This is right after, by the way, Lewis and Clark. Great book. Anyway, so Alice, thank you for writing. Sorry, I got diverted there.
You did go tangential.
Any investment products, she writes, besides Roth that can reduce tax burden on my children who will inherit a large leftover retirement savings when I die. In other words, any way to reduce the tax bill on a retirement account if it's non-Roth.
Retirement account. No.
Yeah. There really isn't.
No, there really isn't, because eventually, I know this is the same refrain that we hear over and over again. Okay, I entered into a deal with the government. I get a tax deduction and tax deferred growth. I entered into that deal with my eyes wide open, but now I want to renege.
Yeah. You didn't pay taxes for the last 30 years. I know.
You got a deal. You got a hell of a deal. And now the kids or you pay the taxes. And so why is it a big deal for the kids to pay the taxes? They're getting free money.
They're getting 75% of that free. I mean, after tax. And by the way, you got to pay attention to the rules around this now, because the 10-year rule thing.
It's the 10-year rule.
Well, but again, I think this year you're still free and clear from not doing it. It goes back and forth. But in 2025, you have to start the 10-year rule. It means you have to take out something every year. Evenly. Yeah. And
so
I think until this year,
there is one strategy, and that's die before 25. No, die before 25.
Okay. That's
the strategy.
We don't do that kind of work here, but we know people. We could put it that way. If that's okay.
Oh, you don't know people.
Yeah,
You're in the Pacific Northwest.
I do
know a
hitman
in the Pacific Northwest?
I do. Actually, I do. Tony. He's old now. I don't think he'd do it anymore, but he's old. It's his past life. I probably shouldn't say that, right? They're probably going to come looking for me.
No,
But
I
anyway,
think this could, the feds are listening. So, Mr. Cock, can you meet us down at headquarters for a little?
I'm very busy today. Got to
take
record.
You in the box
Can't come out of the
and
studio.
Get the rubber hose out and go. You want to tell us a little bit about that?
I want him to write his
hitman?
book, because he knows a lot of stuff about the Northwest. But he's already
yes,
said
he should write his book and then hire somebody to kill himself right after that, so that he doesn't go to jail.
All right, let's get back to the serious stuff of your questions. Mark writes us from Seattle, says, in terms of retirement, I hear a lot of folks say that we should have a guaranteed income stream that covers most or all of our non-discretionary costs. But for those of us who don't have a pension, Social Security may not cover these costs. So assuming we have a 60% stock, 40% bond portfolio, that should be okay in the long run. What is the funding strategy for those times when we have an equity market downturn? Do we draw on the bond funds to cover the essential costs during the downturn and leave the equity funds alone? And also, that seems to be rebalancing. Mark, you're right on all the cases there.
There you go. Exactly.
You answered your own question.
We believe that you use rebalancing to generate income.
But let's go through that carefully, because
let's do it. Yes.
In a 75% of the years, equities make money, basically. So those years,
so you're selling stocks and buying bonds, but
That's
you can use the money from the sale of those stocks to add to your Social Security income to supplement that.
Yeah. And then you correctly point out
the rest.
And then you correctly point out, Mark, that when stocks go down, boy, I just read a piece from Mark Hulbert that really scared me, because it said bear market has to be around the corner. When they go down, exactly.
Someday.
I know. You do correctly. You use the bonds, because bonds are generally stable, right? Mm-hmm. They're not moving up and down a whole lot, and you have to draw something off those. That's exactly why they are in your portfolio. So you can let the stocks rebound while taking money out of the bonds.
If your stock to bond ratio goes to 50-50, well, you're going to be needing to sell bonds to replenish the stocks. So again, you sell enough of the bonds to get the income you need, and then anything else goes into the now lower price stocks.
Bingo. That's exact. So you answered the question yourself. You're exactly right. Here's the thing about saying a 60-40 portfolio should be okay in the long run. We can't say that without knowing your life situation. We don't know how much risk you need to take to make sure you get enough growth in that portfolio. That's part of any good financial plan and planner that's going to sit down and run 1,000 of those, solutions to see if it works. Good times, bad times, whatever, up, down, etc. That would be something your planner should do for you, because in a general sense, would a 60-40 work? Sure. But we don't know your particulars. That's what you need to know in retirement.
There you go. And if you want to learn more about all the little money-making things you need to be doing to sensibly build wealth, go to talkingrealmoney.com and check it out. You can also send in your questions there. You can speak questions there. Or also, you can call us on Saturdays on our show from 3 to 5 Eastern Time. Every Saturday, 855-935-TALK, 855-935-8255. So check us out. Go to talkingrealmoney.com, because, there we're writing about and sharing information about money. But we're also, if you check out the podcast there, we've got like over 1,500 of them. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.